Hello, everyone. Welcome to Wall Street Weatherman. I am Gregory Joseph, and today's show is November 20th, 2025, and it is the pulse of stocks now. So, first of all content herein and views expressed are informational only and not advice to buy or sell any stock or equity. That being said, I wanted to uh, talk about my last show, in which I said I was looking toward two important earnings reports this week, which were last night, NVIDIA, Wednesday after the bell reported earnings, and this morning, Walmart reported earnings. So let's start with Walmart this morning. They beat on revenue, they beat on earnings, and they raised their forward guidance. The reason that I am so tuned into Walmart is because more recently they've started to attract some higher end consumers with households above 100,000 and more per year. And they really encapsulate a wide range of consumers and products as well. And since the consumer in this country, the US, comprises 2/3 of our gross domestic product, which, I think about it. It's crazy. Like we talk about all the businesses out there, technology, all that stuff, but 2/3 of the growth in this country comes from the individual consumer, which is why it's so hugely important. So, Walmart, they raised. That tells me that, and also pairing that with Mastercard and Mastercard and Visa, which are still reporting a strong consumer, that gives me some confidence in what's happening with at the ground level, boots on the ground with the U.S. consumer. So let's talk about NVIDIA. NVIDIA last night, also like Walmart, they beat on revenue, they beat on earnings, and they raised their forward guidance. Just a bit of perspective. NVIDIA for 3 months, which is basically just 60 days of business days in 3 months. They did $57 billion in revenue, 57 billion, which I just sort of wanted to, I think that's amazing. Just wanted to call that out. So 57 billion. And for next quarter, they're forecasting 65 billion in revenue, which I think that's amazing. Just a little bit of perspective on size. And that's why NVIDIA is the largest company in the world by market capitalization. So let's talk about that. NVIDIA beat and raised. Walmart beat and raised. Now, going into this, um, going into this earnings report last week and a little bit of the week before, we had talked about the fact that the technology spend, the artificial intelligence spend and return on investment was starting to be questioned, and that the market had started to sort of bump its head from going higher, had tested 3 times, had tested out key levels and rejected them, fell back. And so uh, the that's sort of interesting, so anyhow, that's what's been driving the market uh, in the last several months has been the AI trade, the technology trade, and now that return on investment and that spending has been called into question. Whereas before, the more the companies were spending, even a couple of months ago, the more they were being rewarded. So it's really a sentiment shift in the stock market. And with that in mind, I again don't try to forecast. I try to tell you what I see and feel going on right now. But with that in mind, the Magnificent Seven, which are those seven biggest technology companies, including NVIDIA and Google, Apple, Meta, Microsoft, Um, they they are so big right now, and they've done incredibly well over the last several years, and they are so large right now that for them to continue that growth um, becomes sort of, the larger they become, the harder it is to keep up with the pace of growth. So what was 20% growth, 30% growth, 40% growth over the last several years, as they become bigger, the law of large numbers just makes that growth percentage automatically, obviously, if not obviously, but if they, it just makes it much tougher for them to achieve those numbers. By the law of large numbers, they have to come down, along with the fact that these companies have been cash machines, they do have incredible balance sheets. And I'm not saying that that's going to stop, but with so much spending going in to the capital expense of buying equipment, of investing in the AI build out, the artificial intelligence build out, and the data center build out, hundreds of billions of dollars going into that. So those two factors, the fact that they're getting so large and cannot, by the law of scaling, keep up that growth, along with this new wave of spending, the forecast for next year, 2026, and I just am putting this into my mind and sharing it with you, that these have been the place to be in stocks in the last 5 years, with exceptions, of course, but downturn in a few years back, but that overall, the place to be. My mindset for 2026, and this is being echoed, just starting to be echoed by the market, is that their growth of those Magnificent Seven companies are forecast to fall by 20%. Okay. So that's going into next year. And I'm not saying these aren't amazing companies, and I'm going to continue to be invested in them to a certain extent. But my question to myself is, am I still going to have such a large position? Am I still going to trade them as actively as I have? Um, with that forecast, with the spending, the growth slowdown, all of that. Now, it's crazy that NVIDIA is at the center of all this spend. One of the companies at the center of all of this, that they make the best semiconductor chip for artificial intelligence in the world, and the best racks of chips. And 40% of NVIDIA's revenue comes from the other six companies. So 40%. And I've flagged that before as a concern for me, because that's a lot of eggs into a very small basket. And I remember back in 2023, when that was the year that Meta was reward. That's when Meta, which used to be Facebook, Mark Zuckerberg, said that 2023 was going to be the year of efficiency, and they pulled back on their hiring and on their expenditures. They pulled back a lot on that, and that was a very sudden, unexpected announcement. And so again, with NVIDIA having 40% of their revenue in this smaller basket, I start to wonder. And I also want to tack on to that the export of these semiconductor chips that NVIDIA makes. They are incredible. And we haven't necessarily, I've chatted about it a little bit, but there are basically none of these chips, not basically, but none of these chips are going to China. The US government is now identifying these as a national security priority, and the export of the highest end chips, which are the Blackwell chip now, and soon the Rubin chip, which is the next generation from NVIDIA. they need to go through the US government first. And that's all I'm going to say about that. As far as they can't just sell them, they now need permission. And when those go out the door, there are also some of them that have a license fee attached to them. So these are things that I think about when I think about NVIDIA, when I think about the overall artificial intelligence framework, when I think about the projected slowdown going into next year, when I think about where these companies have come from. Like I say, if, over the past years, 3 years, 5 years, 7 years, the return from these companies is incredible. And so I look at the run that they've had and ask myself, how much of that run, where's that run, going? What is the forecast of, the slope of that run? And um, and just thoughts to keep in mind. And you know, the the market this morning, I was up as I always am, pre-market, and the market was soaring on the NVIDIA report from last night. And excluding Walmart from this morning, I watched after the market last night, like I do every day, that the question I had in my mind was, how is it that over the past couple of weeks the market has been questioning the large amount of spend in technology, and the question of where is the return on this investment? A large amount of that spend is going to NVIDIA, okay? So when NVIDIA last night reports incredible numbers, the market, which had been, selling off because of the amount of that spend, was verified what they were doing with those numbers from NVIDIA. That was verified. And yet they started buying all of the companies that were making the spend. So they essentially reversed course from the sell-off that was underway. They reversed on these great NVIDIA numbers and started buying the very stocks of the companies that have been investing huge amounts of money, that they were wondering, well, okay, wait a minute, maybe you don't, get my investment dollar today. So the market changed course rapidly last night, and post-market was up this morning. The pre-market was up. NVIDIA was up 6%. And then this morning, it came flying back down. And I mean, like I said, NVIDIA was up 6%. As soon as I turned my camera around to film this, it was down over 1%. So a 7% swing after these incredible numbers, a 7% drop within just a couple of hours of the opening bell. That tells me that the market is absolutely, we're punishing you, we're rewarding you, we are punishing you. The moves are very extreme. So like I told my wife this morning when I was making her a delicious cup of cappuccino, I said the market is manic. Forget about all of the up and down and how much and percentage and all of that. What I see a manic market that is indecisive right now. And when that happens, first rule of investing for us is protect your money. Number one, before you think about making that money, you protect it. And when the market is so manic, it makes drastic, illogical decisions. I step back and I I'm almost always don't get involved in that. So just some observations there. Uh, the the in terms of next year and in terms of the earnings of the market overall, obviously since April of this year when we had the tariff scare and the rebound in the market, the S&P, the S&P 500 has been in a bull market now for 3 years with out with earnings that are above average for those 3 years. So price, earnings drives price, and price will always find the literal earnings of these companies. Sooner or later, what a company does, how much they make, how much they earn, and their free cash flow, the price, that relationship will always find a parity. And so with the market outperforming in the last 3 years in a bull market, with the forecast going forward for the largest companies, those Mag 7 make up 40% of the earnings of the S&P 500. 40% of the earnings of the market come from those 7 companies. I've already told you about the forecast for those companies. So my mindset going into 2026 is I don't predict, but I give probabilities. So my probability to myself is be aware of the decreased forecast of those 7, which automatically translates into a decrease in earnings of 40% of the market. And just something to keep in mind. And so, with that in mind, I just want to wrap up one or two other thoughts, and that is that there are fundamentals and financials, and then there's sentiment. Okay, the the fundamentals of the companies and what they're doing are incredible. And I'm talking about those largest companies that have such an outsized influence on the market, on the earnings of the market. Their financials are incredible, and they're a part of the market sell-off in the last couple of weeks. People have been talking more and more about 25 years ago when there was the internet build out and the internet, the B word, bubble. But I am not worried about that because these companies have, they've got, they've proven themselves. They've got real business with real earnings, incredible financials. Yes, they're spending more via debt now, but it's not speculation was it when it was 25 like it was 25 years ago with companies that have just no revenue, no sales, conceptual, all. So I'm not worried about that, the B word, the bubble. That's me. But at the end of the day, they can have great fundamentals, they can have great financials, financial statements and numbers. But at the end of the day, the thing that matters and moves the market is the sentiment of the market, that these things are hugely important, and over time they do win out. But where the market is today and where the mindset of the buyers and sellers is today is what determines price, the price of the market, and the market going up or down. And so while I'm not worried about that, I will say that the sentiment of the market right now is, like I said earlier, it is erratic. It is, I would say, manic. Remember the VIX? Remember the volatility index? And if you haven't seen that previous video, go into your stock ticker on your little app, like Yahoo Finance that I use. Go up and type in VIX, and you'll see that's the volatility index. That is also known as the fear factor. And it's based off of, we can talk about the the technicals about what it's based off of, but it measures the volatility inherent in the market by uh, an algorithmic conglomeration of the options on different stocks and how much people are paying for, the good, the bad, for the calls and the puts, and the implied volatility in the movement of these stocks. All that translates into basically how much emotion people are buying and selling, or willing to pay for in buying and selling these calls and puts. So I look at the VIX to measure the volatility implied in the market and the fear, again, the fear factor, in the market. And so please look at that and look at the wild swings that we've seen in the last couple of days, this morning being one of them, yesterday morning. The market was fearful. It came flying down and then rocketed straight back up. And so my point being, there are fundamentals, there are financials, there are incredible companies that I'm not worried about, me personally, in terms of a repeat of 25 years ago. However, the sentiment in the market now is unpredictable. That to me raises a red flag or two red flags in terms of protecting my money and looking at the volatility, the VIX index. I really want to point that out. And just a couple of other things. The the Federal Reserve, the minutes from their last meeting came out in this week, and in a nutshell, there are more Fed members that are leaning against a cut in December. And along with that, and I'm just simplifying everything, along with that, the um, less of a cut in December, the probability of that has come down in terms of what the market is forecasting. And um, the along with that, excuse me, along with that, the Bureau of Labor Statistics, now that the government is reopened, is behind with some reports. Well, they just announced that the October labor report is not going to um, be, they're not going to publish that, and that the November report is now going to be published after the Federal Reserve meets in December. So no October, late in November, after the Fed meets in December. The whole point of that is saying that, to me, that sort of those factors tell me that uh, less and less of a likelihood of a cut in December, because the thing that was would have advocated for a cut in interest rates in December is the deterioration of the job market and labor. And we are going to be missing that data, and that data is going to be late. So they're going to have to lean more on interest, on inflation, and inflation is creeping up. And there's the sentiment of the Board of Governors is already on hold, a hold mindset as far as those. So just something to keep in mind. The reason I'm saying that, and forgive me for going on about the Federal Reserve, the reason I say that, not because I think that it really should affect markets that much, it's that it does. The markets listen to the Fed. And I'm going to leave you with this. There's a saying on Wall Street that you don't fight the Fed and you don't fight the tape. Okay. So if people were, even 2 weeks ago, expecting, a cut in December, and that expectation has come way down, and if the market is really questioning that technology spend, return on investment, and the artificial intelligence theme, and the tape is showing that weakness, the price action is weak, then I don't fight the Fed and I don't fight the tape. And so if the positivity of the Fed cut expectation has come down, if the price action of the tape has weakened, that's where my mind is right now. I don't fight the Fed, I don't fight the tape, and I'm seeing some weakness in both of those. So there you go. That's the pulse on stocks for today. And I thank you for watching Wall Street Weatherman as always, and I will see you again soon. All right, stay tuned. Stay strong, guys. We're going to get through this. All right, cheers.